Please stay tuned for important disclosure information at the conclusion of this episode.
This is Destination Retirement with Robert Kuhn from Kuhn Capital Partners. When a part of your financial strategy is out of tune, your long-term goals, your retirement savings, and your legacy can all suffer. With many years of experience in the financial industry, Robert provides his clients and prospects the information they need regarding Social Security, retirement income planning, wealth management, and much more. Listen in as we address your financial concerns and provide helpful strategies to put you on the path to achieving your retirement goals. And now here is Destination Retirement with Robert Kuhn.
Welcome. Thank you for joining us this week. My name is Robert Kuhn. I'm the host of this radio show called Destination Retirement, and I'm also the president and founder of Kuhn Capital Partners. We are independent. We're a registered investment advisory firm, and we are a fiduciary. Everything we do is to educate. We have our new proprietary financial wellness score that we have rolled out. So if you haven't had a chance to take advantage of that, please do. It doesn't matter if you have $100,000 or 10, 15, 20 million. I think there's value no matter where you're at in your financial life. Our job, I think, is to provide safety, security, and income that you can't outlive with minimal risk to the stock market. Our job, obviously, as fiduciaries is to make sure that we are identifying your greatest risks in retirement and then hedging away those risks. If you'd like to have a conversation with us, certainly a lot going on in the market. There's a tremendous amount of volatility, and I don't think that is going to change. I think we're going to see that for some time. Give Paige a call this week, 630-492-1912, 630-492-1912. If you've called in the past and we never had a chance to communicate, let's make sure that you reach out again. I want to introduce the financial wellness score to you, and I think it's just knowledge. I think knowledge is power, especially in the world that we are in. As you know, if this is your first time listening to the radio show, welcome. We do see a lot of podcasts, a lot of downloads to the podcast. We do podcast this radio show every single week on the website. Very happy to announce again, it seems like we're always tinkering with the website, but we're certainly making changes to the website. We want simplicity. We don't want people to get lost in the website. I think there's value in what we do. As you know, I believe the majority of financial advisors are truly adding no value because your portfolio simply goes up and down with the market. That obviously is going to be a challenge, especially in this market. If we see a sideways market for some period, I'm going to start to share the Microsoft statistic a lot more because I think that's one of the greatest risks to the market is a sideways market. I believe that if you are 5 to 10 years from retirement, or if you're in retirement and we see a 5 to 7 year sideways market where the market doesn't do a whole lot, that's going to be a challenge. That's going to negatively impact your portfolio. And we want to make sure that we have strategies in place that, we can still take advantage of the volatility. So the Microsoft statistic, if this is your first time, if you had bought listening to the show, if you had bought Microsoft in 2000, it actually took you 16 years to get back to even. I mean, think about that, 16 years to get back to even. Yet Microsoft during that period tripled, quadrupled their earnings. It just is, unfortunately, you bought it at the wrong time. We saw a loss in the market. And then we just really had a sideways market. And so it was a challenge. And I don't think people, and I don't think advisors, more importantly, are protecting their clients against the what ifs of a long sideways market. Because if you look at where the market is trading today, I know we often don't talk a whole lot about trading strategies, but you look at where the market is trading today, it's very, very range bound. And we're up, we're down, we're up, we're down, we're up, we're down. It's a very if you look at kind of the range, it's pretty narrow, and that's going to be a challenge. And I think we may see that for, an extended period of time. And if this is your first time listening to the show, we believe in a sleeve approach. The sleeve approach, we think, ultimately is going to provide the clients, the investors, the best chance to make money. Our sleeves are unique. They're understandable yet complicated. They're really just, there to provide, certainty in a very uncertain market. So we have the guaranteed sleeve. A lot of individuals are, obviously excited about that today. I mean, you can still get up to 15% of the S&P 500 with no downside or risk to your principal. Gains are locked in annually. That doesn't mean that there's not things we need to discuss. I mean, every investment has a pro and a con, but when you look at that protection sleeve, it is a very appropriate sleeve right now. We don't talk a lot about kind of guaranteed income on the radio show, but I think when you have guaranteed income at distribution yields that you simply can't get in many places, there's strategies out there that provide them. We have to have that conversation because I think then it frees up your rest of your assets for growth. And at the end of the day, what are we doing? Whether you have 100,000 or 10 million. I think you have to produce income. And if there's two things that I've seen lacking in the financial advisor space, as far as advisors who are giving, advice, it's first off tax mitigation. There's very limited tax mitigation strategies. And if you're working with a big bank or a big brokerage firm, you are absolutely missing out on tax strategies. And there are strategies available today that we can greatly reduce your taxable income. If you sold a business, you sold a building, you sold whatever, you make a bunch of money. Let's talk about those strategies. And then the second strategy that I think is missing out greatly when it comes to financial advice is really income distribution. I mean, are you just dollar cost averaging out? Well, that's not an efficient way to manage money, in my opinion, because if you are having to allocate probably more than you should to generate the income that you need, you also have, what are you doing when the markets are down? You're taking out, money, and then that's less money that's going to be in the portfolio ultimately to recoup. And then we have our growth sleeve. As you know, the growth sleeve is mathematical. It is very systematic. It's very forward-looking. I think that is very important. And then the last two sleeves are our opportunistic growth sleeve, which I think in today's day and age is especially in this market, we've made a tremendous amount of money. Now, past performance isn't indicative of future results, but when we do see a kind of a market that is, somewhat, I guess it's never predictable, but, when we're very range bound, there are patterns. And if we can take advantage of those patterns to make money for clients, then that's our job. And if you've listened to the show, you know that if you do have over $2.2 million of investable assets, you have access to the KCP Opportunity Fund. And we certainly would love to have that conversation with you on what the fund is, what the fund's not, but it's maximum flexibility. We can make money when the markets go up or down or sideways. And that may be 10% of your portfolio, maybe 20% of your portfolio, but we think it's a very, very vital component of a portfolio. And then lastly, our alternative sleeve, it's all about cash flow. There's, I think it's very rewarding and it's very comforting when you have investments that are paying double-digit distribution yields, and those are coming in irregardless of what goes on in the stock or bond market. And that is very significant, especially in a sideways market. And if we have a strategy like that can greatly reduce your taxable income, especially for Roth conversions, well, it's a conversation that we certainly need to have. So with that being said, those are our strategies. We're very proud of them. It does take a couple conversations to fully understand them. But if you want to have that conversation with us and you want to learn a little bit more about what it is that we're doing, why it's different, why it's unique, why we think we could either act as a satellite to what you're currently doing or really a core to what you're currently doing, give Paige a call and we can have a conversation this week, 630-492-1912. 630-492-1912. A lot of news this week. Obviously, the debt ceiling is a concern. The debt ceiling is something that, we can't ignore. Everybody thinks ultimately they're going to work it out, and that certainly has been the case in the past. But we have to look at and we have to potentially hedge against the what ifs if they don't. And at a minimum, it could be a great trading opportunity. And I think, in this day and age, people have, trading is a lost art. I mean, you have advisors that are providing financial advice, and generally speaking, their job is to gain more assets so they can charge a fee and then they can see their own personal income go up. So, most traditional financial advisors just, they don't have any trading strategies inside of their portfolio. And if you have good mathematical, systematic approaches to buying and selling for some of your money, again, it's a sleeve, right? It's not 100% of your money. Why not? And, in this market, there's just tremendous opportunity. So if we do see a debt ceiling that is still, in a stalemate, and there are still issues, and the government can't seem to get their act together, I mean, there's a high likelihood that we see a pretty meaningful pullback in the equity market. And wouldn't it be nice if you had 15 to 20% allocated to what we call opportunistic growth? That means that we want to take advantage of near-term pricing dislocations in the market. Well, wouldn't it be nice to have that cash available, that if we did see a 3, 5, 7, 10% pullback in a relatively short order, to make or really take advantage of that? And again, if we're in a sideways market, if we are in a period where you listen to a lot of the talking heads, I mean, we're going to talk a lot about Stanley Druckenmiller and kind of, what he had said this week. And clearly, I guess any way you look at it, his performance is reportedly to be one of the best. I mean, I've seen 30% averages over 30 years. I mean, given that we don't have money with them, I mean, I certainly don't know, but what's widely reported is out, just phenomenal rates of return. And he's very concerned. And, he made a really, interesting, I think it was tweet or a comment or something this week that, I think one of the greatest risks, ultimately to the market is a sideways market. And guys like him have been saying that we're in an asset bubble like that we've never seen. And there's always an edge. There's always an angle. There's always a reason people are saying certain things, especially in this business. So I don't know if you take that as purely black and white and you pull all your money out and put it in your safe or bury it in the backyard. But, there certainly are issues. And, as you know, with the radio show, I think our job is to educate you on what individual advisors just are not doing for, clients. And I think that is the gap that we're trying to fill, is that if we are, excuse me, this week, I seem to have some congestion. I apologize. But if we are in a very interesting period, well, what happens if, the markets do drop and things go on sale and you have, 100,000 or you have a couple million, 5 million, whatever that number is, but your advisor has you fully invested? Well, how are you going to take advantage of buying things at a discount? And it, it just goes back to our sleeve approach. Most people that we talk with and most listeners, you think you're diversified. Well, you're not, because you own two things. You own equities and you own fixed income. That's not diversification. I mean, you are going to simply ride the market up and down. And the sleeve approach, which we're going to talk a lot more about, in my opinion, is the greatest way to manage your money. And I think if we're trying to provide safety, if we're trying to provide security, if we're trying to provide ultimately, future income that, has minimal risk or is de-risked to the greatest ability that we can to the overall stock market, which is something we can't control, I think you must have sleeves. You have to have protection, whether it's growth or income. You have to have growth. You have to have opportunistic growth, and then you have to have alternative, strategies that produce cash flow no matter what. Well, not no matter what, but they're not dependent upon the stock and bond market. And when you look at, these just ridiculously big firms out there that, put these cookie cutter supposedly custom portfolios together, you just have to ask yourself, do they ever go to cash? Do they ever play defense? What's your protection strategy? What is your cash flow strategy that's ultimately going to pay you no matter what happens in the stock or bond market? And it's just not there. So, again, 630-492-1912, 630-492-1912. And we want to have, certainly a conversation. Our financial wellness score, which we just rolled out, is a proprietary software that we have access to. And then we've made some changes to the output. And what we're trying to allow individuals is in a very short order to see if we really need to continue the conversation with us or any advisor, because I can't tell you how many people think they have something and they don't. And so that's our job. We're going to get more into that this week. Thank you for joining us. My name is Robert Kuhn. I'm the host of this radio show, Destination Retirement, president and founder of Kuhn Capital Partners. If you'd like to have a conversation with us this week, please give Paige a call, 630-492-1912, 630-492-1912, and she'll set some time for us to have a conversation. More after the break.
Would you like your portfolio to be more certain in uncertain times? These days, there are more questions than ever. Before we can get to the answers, we have a question for you. What do you want to accomplish? Understanding the bigger picture is the first step to helping you pursue your goals today, tomorrow, and for generations to come. To schedule a complimentary call with Robert, please call 800-674-3217. Again, that's 800-674-3217. With Kuhn Capital Partners, partnership isn't just a promise, it's in our name.
You're listening to Destination Retirement. Thank you for joining us this week. I hope everybody's having a great weekend. I want to wish all of the mothers and my wife and my mom, my mother-in-law, and my grandma. I want to make sure that everybody knows that I want to wish them a very happy Mother's Day, and hopefully everybody is spending some time with their mom and the family, because it's obviously important. So I want to again thank everybody for joining us, listening to this radio show. We do come at you every single week. We also do podcast the show at kuhncp.com, kuhncp.com. We ask that if you find any value, go to the website, go to kuhncp.com, click on the radio show link in the upper right, and you can send on the show to anybody you feel needs to listen to it. Again, we are very adamant about giving investors clarity, giving investors peace of mind, giving investors a level of certainty that they may not have, especially in this market. So give Paige a call this week, 630-492-1912. You can call her today, call her this week, but she'll certainly set some time up for us to have a conversation, 630-492-1912. Doesn't matter, if you have $100,000 or if you have 10 million, 20 million, 30 million, it's really irrelevant. I think our job is to help every investor out there. We're not that type of an advisory firm that only wants to help people with certain amounts of assets or certain level of assets, rather. I think everybody needs help. And when you have a good strategy, when you have a good, really a good investment philosophy, when you look at sleeves, I want to keep hammering that on the radio show. I promise you, most people listening, you have two strategies. You have equities, you have fixed income, and ultimately that's going to be a challenge in a sideways market. To stop and think for a minute, what happens if we are in a sideways market? What happens if we have another Microsoft scenario where if you'd bought Microsoft in 2000, it took you 16 years ultimately to get back to even. So that's a sideways market where you're up, you're down, you're up, you're down, but we don't really, go up and to the right in a meaningful way that's sustainable. So you have to ask yourself what happens if that does happen. So a couple of things I want to talk about this segment. I think when you look at, we are in a, if you look at the markets, we've been trading between 3,900 on the S&P to 4,200. It's a pretty defined range. It's a range that if you have a buy and hold strategy for 100% of your money, I think it's going to become frustrating. As we mentioned in the first segment, when you have a sleeve approach, and we have for you distinctly different and unique strategies: protection, growth, opportunistic growth, and then alternative. I guess I should call it cash flow, because that's really what it is, a cash flow strategy. Well, in that type of a strategy, if we're in this type of a market, well, we have assets, we still have investments that are producing. And, that to me is going to be put at a premium. And if you have an advisor that only has stocks, equities, ETF, mutual funds, and bonds, you're just going to have a challenge. And please listen that you don't want to, look at that and examine that philosophy and the buy and hold philosophy 3 to 5 years from now, because you could, see a 3 to 5 year period where there's not a lot of meaningful growth. Let's examine it now. Let's have a conversation now. Allow us to educate you on, why the sleeve approach, in our opinion, is much more appealing. It's much more dynamic. It's much more active. And it ultimately, we believe, is going to produce greater results for you. So when you look at kind of where the market is today, and I think it's one of the most unsustainable situations that I've seen in an extremely long time. I mean, we have 7 companies, and you look at Apple, Microsoft, Amazon, Google, Tesla, NVIDIA, Meta. I mean, there's a handful of others, but it's there's a lot of acronyms out there. But you can just Google it, FANG, and there's several variations of FANG. But when you look at those stocks, the concentration risk of those stocks is seriously off the charts. And I think it's distorting the overall indices, which is great for people who just own the S&P. But you look at those, let's just call it up to 10 companies, 7 to 10 companies. You look at the returns that those are driving of the overall S&P 500, or you look at the returns that they're driving of the NASDAQ. I mean, depending upon day, I mean, you can look at just those names representing 60 to 70 to 80% of the returns of the S&P 500 or of the NASDAQ. And if you look at the weightings as far as what they make up of the indexes, I mean, they're making up 24%, 25% of the S&P, 51%, 52% of the NASDAQ 100. I mean, it is just off the charts. And so what happens when you can't hide anymore, and something that, everybody has been talking about, what happens if there is a liquidity issue? What happens if, we see more regional banks fail? What happens if there's, the market's just, everybody rushes to the sidelines, and you have, massive protection that's put in place, and you have the market that is so concentrated towards the top. We could see, the old adage is, you stair step up and you elevator down, meaning you're up, you go sideways, you go up, you go sideways. Think it's just like walking upstairs if you look at it from the side. And then, generally when the markets drop, I mean, the elevator down, meaning it just goes down, and it goes down very, very quickly. These are the risks that I'm concerned about, that most people are not protecting against. And not only are they risks, there's also tremendous opportunity. But it's likely that if the market does have, significant issues, and you have such a level of concentration at the top, that we could see, pretty substantial losses in a relatively, short order. And, I have to, make sure that I'm not saying that that's our base case, but when you look at Stanley Druckenmiller, and you just Google him, and you can Google his performance, and when he's quoted as saying that I'm sitting here staring in the face of the biggest and probably broadest asset bubble, forget that I've ever seen, but that I've ever studied. I mean, that has to, at least at a minimum, make you question, stop and think, why are these investors who have had, historically phenomenal rates of return, what is it that they see that ultimately that, investors don't see, or many advisors don't see? And I think it's, when you look at, when people receive financial advice, and you look at, talking with a financial advisor, I think their job is to just say everything is going to be fine, and there's nothing to worry about. It's ultimately, time in the market. And it's, you have to stop and think, well, wait, I mean, is that what you're doing with your money? I mean, how are you managing your personal assets? Is there a difference between what you're doing personally? Because losses affect, us, losses affect the individual a lot greater when versus clients that lose money. I mean, think about it, and I think one of the greatest questions to ask an advisor is, what are you doing with your money? Show me. And are you just promoting a buy and hold strategy? And that's what you're doing with your clients or your personal money, or is your client money buy and hold, but yet you're much more active with your own personal money? And I think that's a question that needs to be answered. And I think that, the buy and hold myth is, it is just going to come tumbling. It's already come tumbling down. I mean, just look at last year. The only traditional, way that, most advisors manage risk is fixed income. And fixed income was down 15 to 30% last year. So when you have guys like Druckenmiller that say, say, if I like the stock market, I would be exposed to it, and I'm not exposed to it now. I mean, these are guys that have, it's reported, 30% rates of return for 30 years. Now, again, I can't vouch for that, but that's just what is reported in the press. So you have to look at what it is that the individual investors are doing that, or you have to look at what the big pools of money are doing that individual investors are not doing. And, to me, it all comes back down to, well, how are we constructing your portfolio? And that, to me, is the greatest challenge, the greatest risk. And really, I can look at that and almost immediately and tell if you have a good strategy, if you're with a proactive, forward thinker of an advisor, or if you're just paying for something that is, you're getting absolutely no value out of. And, the financial wellness score, which we haven't talked a whole lot about, we talked about it briefly in the first segment, but it's really a quick snapshot because we talk with so many, listeners each week. And, generally speaking, for whatever reason, they reach out, but they don't really know, should I reach out? They don't really know, is my portfolio, maybe my portfolio is really good. I mean, everybody likes to think they have the best. They have the best advisor. They have the best strategy. They have the best, but yet they're paying for something that they could do on the computer in 10 minutes, right? And that is, again, probably what 90 to 95% of listeners here today have. You have something that your advisor, you're just not adding any real value. You would be very hard pressed to replicate our strategy. I'm not saying that it can't be done, but it would be very hard for you to replicate a four-sleeve approach of protection, growth, opportunistic growth, and then cash flow. Those strategies, you just good luck. You probably couldn't do it. So we wanted to create in really quick order a financial wellness score that I could tell you with a level of certainty that, we should continue the conversation, or, there's really no need to have a conversation because your portfolio, isn't bad. And so we are really starting to promote the financial wellness score. It doesn't cost you anything. It's a little bit of time on the computer for you to go through kind of a questionnaire. You could do it on your phone. It's simple. But that's going to be our first step going forward is let's complete the financial questionnaire. Whether you have 1 million or 20 million, it doesn't matter. We're going to do it. And if we see that we can add value, and if we see that there are deficiencies inside of your portfolio that are being masked simply because of the market movement up, those ultimately are going to be an issue. And it may be at the exact wrong time. It may be a year or 2 or 3 out from when you are getting ready to retire and you see your the portfolio drop 20 to 30%. Well, that's terrible. So wouldn't you rather know that now? Or if you're in retirement, and we're going to look at kind of cash flow analysis and making sure that, you are utilizing a proactive, forward thinking distribution strategy. And so that's what we're going to do. It's complimentary. I think it'll give you great insight. 2 outcomes could happen. 1, you confirm that, I've got a great portfolio. Or 2, I thought there was issues, and there are issues. And if you're not 100% certain that you can handle a prolonged sideways market of 3 to 5 years where the markets don't do a whole lot, or a 2008 situation, which I think is unlikely, but we may see it, then let's just do the financial wellness score. It's an exercise that I think will provide a level of clarity, and we're giving it away. So it doesn't cost you anything but maybe 20 minutes of your time. So give Paige a call this week, 630-492-1912. We can chat about that or anything, investment related. 630-492-1912. When we get back, we're going to talk about the Great Depression and what that indicates, or what did we learn from that going forward. So more after the break.
Hoping is good. Knowing is better. You are unique, and your investments and plans should reflect that. Investors today want to find outcomes, not investments that simply track the stock market up and down. Did you know most of all mutual funds and managed accounts by prospectus must stay fully invested no matter how good or bad the stock market is? There is a better way. We want our clients to use portfolio gains to compound their investments, not make up for portfolio losses. Schedule a complimentary call with Robert. With Kuhn Capital Partners, partnership isn't just a promise, it's in our name.
You're listening to Destination Retirement. Thank you for joining us this great weekend. Mother's Day is tomorrow. I want to wish all the mothers out there a happy Mother's Day. My wife, my family, my mom, my grandma, everybody. Happy Mother's Day. Hopefully everybody gets a chance to spend some time with your mom. If you can't spend some time, make a call, a text, an email. I think obviously that's important, especially in this day and age where we don't know what is going to happen. So lots of unknowns in life and lots of unknowns in the market. Our job each Saturday is to try to educate you, to try to provide a level of certainty, of peace inside of your portfolio that you may not have currently. That's our job. We're sticking to it. We know based upon the listeners, we know based upon 25 years of being in this business, that most of you don't have any proactive risk management in place, meaning you're just going to ride the roller coaster up of the market and ride the roller coaster down of the market. And that's a challenge. It's a challenge, especially in this market. So if you want to learn more about our financial wellness score, I think it's a great report. It's a report that we're giving away. It's complimentary, at least for the time being it is anyways. I don't know if we're going to ultimately charge for it because there is some work on our end. And it's not necessarily, charging for it to make, have it be a line item in our business on the revenue or of revenue. It's really just commitments. And if you're committed to learning about your portfolio, if you're committed to, walking down and, or through an exercise of making sure that your portfolio is bulletproof or can, provide at least, a level of comfort or certainty that you currently don't have, and you're willing to have that conversation, then we want to make sure that, we're providing some value there to give you something to think about. That's our job. Our job isn't to say and tell everybody we can help you. We think we can help everybody clearly, but a lot of people don't need help and a lot of people don't want help. And so the financial wellness score, I think, will really help kind of in very quick order, let you know if we need to continue the conversation. So initial conversation certainly is complimentary. It's educational. We're just here to chat. We like to have conversations with investors. Even if you don't become a client of ours, we just enjoy having a conversation about investing or money or retirement or risk. And we can do that by setting a call up with Paige. You can call today. You can call this week. But set up your complimentary call. It's 15, 20 minutes. And sometimes they run longer. It's really, what questions that you may have. But 630-492-1912, 630-492-1912, and we can set that conversation up this week. So let's get to kind of the topic this week. We've, always talk about downside risk management, but a couple, announcements, and I want to still, share with you, our protection bucket. We're still seeing ridiculous protection levels on the S&P 500. Some of the strategies that we have access to are providing significant protection, but with meaningful growth. I mean, we can protect your money, 100% sit in a cash account or a government. It's backed by the full faith and credit of the government if you're investing in a treasury type strategy, short treasury strategy. I mean, you can get protection. That's not the issue, but it's protection with growth that I think is the issue. And so when we, as we believe in a sleeve approach, and our protection sleeve, whether it's growth or income, on the growth side is up to 15% currently of the S&P 500, at least this year. If you start the investment, and what that means is your principal's protected against loss. It's not FDIC insured, of course, but it is by the issuing company. So you have to make sure that you're working with a good credit quality, company, which I think as long as it's a big bank or a big insurance company, I think you're going to be fine there. But it is protected against loss, which everybody likes to hear. But what I think is really important is the fact that your gains, if you have any, are locked in on an annual basis. And so that's the big deal. So if we are in a sideways market where we have up years and down years, and we can lock those gains in annually, so you're not having to play that catch-up game following a down year, I think that's a pretty appealing strategy. And the nice thing about it is they're relatively short investment periods. There's 5 years, there's 7 years, there's 10 years, there's 14 years. So, I mean, it's really, what are we trying to accomplish and how liquid does, the capital need to be? But so up to 15%, really good. On the banknote side, we did a banknote this week that had 30% downside protection. And so that means that as long as this one happened to be tied to the S&P, the Russell 2000, and the NASDAQ, as long as those three indices, the least performing, didn't drop more than 30%, you were paid 10.5. So it was a short-term note, 3-year note, 10.5%. So again, really, really appealing for some safe money. That if we're in a sideways market, it's nice to know that you have some cash flow coming in, even though the markets may not be going up. So that protection bucket is made up of many different strategies, but it's a very core component of an overall portfolio. Cash flow, cash flow, cash flow. You just have to have cash flow coming in. You have to. You can't have 100% of your money dependent upon a green arrow on CNBC. So let's get to the topic of this segment. When we look at the Great Depression, it's obviously it began in August of 1929. And it really caused, at least in my opinion, caused the Great Depression was the economic expansion of the 20s. Ultimately, once it came to an end, a series of financial crises punctuated the contraction. And I think when you look at the Great Depression, what would a depression be today? It's kind of like a bank run, right? A run on the bank, it's when money starts to flow out, you run to the bank, you try to take money out. And that in and of itself was an inherent hedge when you didn't just have to press a button to withdraw. It's reported a lot of these regional banks, we don't want to pick on any one, but, you had $40 billion within a day or two, taken out of the portfolio just by logging into your banking app. And so when you look at, we often talk a lot about hedging, of course, and we hedge every area of our life, life insurance, homeowners insurance, car insurance, rental insurance, whatever, health insurance, you're trying to protect from the unknown. But yet when it comes to your largest asset, in a lot of instances, you have no protection in place. You have no protection in place other than time in an up market. And depending upon where you're at in your investment life, that could be catastrophic. If you're in retirement or if you're 5 to 10 years from retirement and you have no protection in place, what happens if the markets drop 20% or 40% or 10% a year for the next few years, or they don't grow? Ultimately, what is going to happen to that portfolio? I think, listening to an advisor say, it's going to come back. It's time in the market, not timing the market, which are all things that we agree with. That probably is going to get old. And our competitive advantage in our portfolio construction is the sleeve approach. We have different sleeves that are going to act differently in different markets. So, we have a buy and hold sleeve. Now, that's in the growth sleeve, and it is forward looking, and it is, active management. So it's not buy and forget. But, it is buy and hold. But the protection sleeve is totally different. The opportunistic growth sleeve is totally different, where it can buy and hold. It can bet against the market. It can, take short-term trading profits, per the second if we needed to. So, that's a great sleeve to have. And then, the cash flow sleeve. And so we're not the advisory group that is just pigeonholed into one strategy. The markets are going to do what the markets are going to do. And we think that a good advisor is going to have strategies in a portfolio that can weather all markets. And if you have a buy and hold strategy, you're at a disadvantage. And at a minimum, you're not making as much money as you could, in our opinion. So, you look at the Great Depression and, we look at, there were some economic shocks, and we're going through an economic shock right now. And, that economic shock is what has happened to interest rates. And I don't think individuals fully grasp the, just how, what an outlier it has been with the Fed doing what they've done. And, something is going to break, and we've already started to see it. You have some regional banks that are very important parts of our economy, of our community. A lot of times you have the community banks that have good relationships with the small business owner, or, the business owner that, I don't want to say is ignored by, the big banks, but, they've got a great relationship with the community bank, and they're going to be able to lend to, a lot of business owners that are going to produce, hopefully growth. They're going to supply jobs. They're going to, create value in their community. And when you see interest rates doing what they've done, it doesn't mean that the Fed, isn't going to accomplish their mandate, which is price stability and full employment, because, again, I don't know what a hard landing is versus a soft landing on it. I do know what it is, but, technically I don't know exactly how you determine it. But is that where we're at in the world today? It's a no landing, soft landing, hard landing, medium hard landing, medium rare, extra. It's craziness. And so we have to make sure, again, that, you look at what happened in the Great Depression, you look at the fact that the 20s were what the 20s were, and then we had significant contraction, and we're going through and just starting that, I think, currently. And I don't think people fully appreciate what that could lead to over the next 3, 5, 7, and 10 years. And you don't have to have an '08, which you see a 40% drawdown, because generally when you see those big, dips immediately, generally speaking, they're bought and the markets ultimately come back. Now, they're very stressful, and most people's portfolios are not constructed to take advantage of, those periods of the market, but generally they come back. What worries me is a no growth or a stagflation or a low growth environment where we're not even keeping up with inflation. And that, to me, is why you have to have that protection bucket and that cash flow bucket, and really the opportunistic bucket as well. And if you don't have it, you're at a disadvantage. So the financial wellness score certainly is something that I think hopefully everybody recognizes that there's value there, and you should really, take advantage of that. So give Paige a call, 630-492-1912. Let's have a conversation this week. 630-492-1912. We'll go over that. We'll answer any questions that you have. We'll look at your portfolio. And also 401k money management. That's a big push for us. So we have a really unique strategy that if you're with a Fidelity or a Charles Schwab or an Empower, that's where your 401k is. There's really there's a high likelihood of an opportunity that we could provide professional money management inside of your 401k that could really benefit you. So more after the break.
Are you considering buying an annuity? Or did you buy an annuity because you were promised stock market-like returns with no downside? If you own the wrong annuity, there is a great chance you've experienced little to no growth over the past few years. In many instances, the insurance agent received more in commission than many have in actual investment growth. If you'd like to learn more about our annuity repair strategy, please call Robert, 800-674-3217. Again, that's 800-674-3217. With Kuhn Capital Partners, partnership isn't just a promise, it's in our name.
Back, you're listening to Destination Retirement. Thank you for joining us. Happy Mother's Day to all the mothers out there. I want to thank everybody for joining us this week. Just as a reminder, we do podcast this show every single week at our website, kuhncp.com. kuhncp.com. You can listen to this show, all past shows. I think that's really important. I think if you're working with an advisor, I think it's nice to know what they were thinking and we can go back, we've been on radio forever, but here on WLS, I think the last 3 years is we did take a break in, I think, one of the summers. I can't remember which summer, but so we were off for a little bit, but certainly since for the last 3 years here on WLS. And so I think the bulk of our shows are podcasted and they're on the website. So it's really great to go back and pick one and listen to it and see if we were saying the same thing, regardless of what was going on in the market. And we're not the advisory group that's going to sit and show you something that did well in the past, because it's irrelevant. What happened in the past means absolutely nothing going forward. It may make you feel good. It may make you think that we're geniuses, right? But it doesn't mean a whole lot, because it's as valuable as yesterday's newspaper. So obviously there's not a lot of value there. So I think when you construct a portfolio, it's all forward looking. Has to be forward looking, because and you look at kind of, I think one of the reasons that people don't show you a lot of the strategies that have done bad is because it doesn't look good when you run an illustration for a client or a new client that you're in an asset class that was down. Well, so what? I mean, it's like, whether we own that asset class or we didn't own that asset class, you look at kind of small caps right now. I mean, they're challenging, but does that mean that you shouldn't own them going forward? And so this whole industry is there's just so many conflicts of interest. And I think our job is to educate and to really bring those out. And that's what we're doing. So, and it served us well. I mean, selfishly, it has served us well. I mean, if you look at our growth, it's been fantastic, but our growth couldn't be good unless we were bringing, value, and value doesn't mean that it works all the time. I mean, it's been a crazy market the last 18 to 24 months. But if we have a sleeve approach that is just giving you more opportunities to make money, that's ultimately what it's doing. It's giving you more opportunities to make money. I think that is starting to appeal to people. People are finally waking up that the big banks, the big brokerage firms, the big, do-it-yourselfers, they preach things that are outdated. They preach things that are easy because ultimately they want that fee. They want that fee today. They want that fee in 5 years. They want that fee in 10 years. So they make you feel good about losing significant amounts of money, like last year in the fixed income space, 15 to 30%. It's like, my goodness. I mean, that's a fireable offense in my opinion. So give Paige a call. Let's talk about our financial wellness score. Let's talk about our portfolio review capabilities. 630-492-1912, 630-492-1912. Give her a call today. She'll set some time for us to talk this week, next week. That's mutually convenient. And it's a 15 to 30 minute call. And we're going to go over what it is that we do, answer any questions that you have, and see where that leads us. So 630-492-1912. So Google search, I was really, interested this week. I saw Google search interest for money market funds is now at the highest since September 2008. Isn't that just so classic, right? I mean, if you look at September 2008, clearly it happened to be the month that Lehman Brothers collapsed. But people are searching for alternative to bank deposits, and people ask me often, what my thoughts are on the bank. And I mean, they're issues. I mean, they're just issues. Is it manufactured by the Fed because they've taken rates from low to high in an unprecedented amount of shortness of time? Or is it bad, decisions by the management of the bank? Or is it a combination of the two? I mean, the reality is nobody knows. I mean, I think each bank is independent, but when I look at what investors are looking at, and Google and all of the search engines, I mean, they're a wealth of obviously information, if nothing else, that they sell and utilize, take advantage of. It's free, right? I would pay, I don't know what I would pay, but I would pay something if they didn't track us. If it's free, generally we're the product, and that's what's being sold. So we can go down that rabbit hole, but I'll try not to. But when we look at, Google search and money market funds, I mean, yes, it's nice that money market funds are finally paying something. I started rather in the business in the mid 90s, 96, 97-ish. And, interest rates, I mean, heck, we were looking at 7% tax-free insured municipal bonds. I mean, that's a pretty darn good, rate of return. And then obviously, we've looked at, the economic environment of just what's happened since I've been in the business. And, we had the crazy 90s, we had the dot-com bust, we had the crazy growth and credit expansion into '08. Then we had the great financial crisis and what happened there with real estate and homes and then, the market. And then we had to look at what the Fed had to do. And, we had 2011 to 2021 or somewhere in that area, maybe not 2009 to 2021. I mean, it was depending upon indice, 15% annual rates of return and interest rates were zero. And now here we are in this great experiment in that, interest rates, they did what they did last year. Now all of a sudden we've had regional banks and banks having issues. I mean, that's all just within 20 years. And my fear is that, every time, early 2000s to 2010, the market, didn't do anything. And so that was kind of the lost decade, like you've probably heard. But, everybody becomes so accustomed to, well, ultimately the market's going to come back. We're going to be fine. Well, I mean, yes, until it doesn't. Right. And so when you have, I don't think it's as amplified if you're still working, but if you're 10 years to retirement or in retirement, it's an issue and it could be an issue like we've never experienced. And so, that's why we, are so heavy on this financial wellness score, that we can at least educate you on some risks that you may not see. And again, whether you have 100,000 or 50 million, it doesn't matter. It's nice to know that there's potential risks ultimately before they happen. And that's what the financial wellness score is designed to do. It's not perfect. I mean, nothing is perfect, but I think it's good, and good is good. I mean, I think that'll give you some, something to think about, because, I can talk all day, and some things, even if I don't know what it is, I can talk about it where you may think I know what it is. And so in this industry, it's one of those industries that is really candidly pretty easy, but it's an industry that if you don't live it and you haven't breathed it, it may seem kind of like a black box. And there's some words that advisors use that make them seem so smart when it's just so basic stuff. But, the point I'm getting at here is that, there's a lot of good salespeople and there's a lot of good talkers in this industry and in any industry, candidly. So let's just let the numbers talk. And to me, that's the most important thing, because what I think or what somebody else thinks is irrelevant. And candidly, what you think is irrelevant, because, as humans, we want to tend to feel good, and we're going to anchor our opinions or our beliefs to people that tell us things that make us feel good. And that's not the job of an advisor. The job of an advisor is to be 100% transparent, to be 100% upfront, and not scare you or not tell you that everything is great when it's not. But let's just let the numbers and dictate, what your financial wellness score is. And if you're uncomfortable with that wellness score, well, then clearly we need to have a conversation. So, it's something that we're going to talk a lot about through the summer. But 630-492-1912, 630-492-1912 if you want to have a conversation about the financial wellness score, or if you want to have a conversation really about anything when it comes to investing. But, money market rates at 4.5% are great. I mean, they're a heck of a lot better than zero, right? But, what's the inflation rate? I mean, 5, 6, 7, 10, 15, 20. I mean, I don't think anybody truly knows. And so are you actually making any money by having your money, sit in money markets? And, yet you have that, peace of mind, I guess, in that you're not seeing your account go down, but you're certainly potentially losing your, future purchasing power. So I think investing is all about give and take, and it's all about, finding what risk you're willing to live with, because that is, what's important, because everything has risks. You put all your money in CDs. Well, phenomenal. You can probably sleep at night, but what's that going to do to your purchasing power in 5 to 7 to 10 years? And so are you really just trading one risk for another risk? And maybe that sleep at night risk is what you can live with. And, if that is the case and you want a level of certainty, well, we can certainly put a portfolio like that together that's going to give you an opportunity to make, we think, historically much more than what money markets are paying. But that's all investing is trying to identify what risks you're comfortable with living with every single day. And, that to me is certainly something that I think the industry has not done a good enough job of explaining. I think the industry has not done a good enough job of articulating, cash flow in retirement. And even if you have $20 million, I mean, it's, again, you've heard me talk about it over and over on the show. Those investors that have a couple $1 million or less of investable assets, it seems to be their main concern is, how are these assets going to produce future cash flow? And that seems to drive a lot of the investment decisions. And those that have, 3 to 20 million, they don't seem to worry about cash flow because they're not worried about meeting their monthly living expenses. But that doesn't mean that you shouldn't optimize, your strategy. So the protection sleeve, phenomenal right now. Growth or income. I want to make sure that, the growth sleeve is what the growth sleeve is. I mean, top rated strategies. I mean, they are what they are. They've done really, really well. Two things I want to really stress: the opportunistic fund. If you have over $2.2 million of investable assets, or you have $1 million with our firm, you can access that strategy. I think in this market, it's very conducive to that strategy. I think when we have, the volatility that we're having, strategies like that can do very, very well. So let's have a conversation about that. And then the cash flow strategy with significant tax, reduction. I mean, that's just huge. Double-digit cash flow with significant tax benefits. Clearly an allocation to that makes a lot of sense, especially if you want to do Roth conversion. So this week, I want to again thank everybody for listening. Happy Mother's Day to all the moms out there. Hopefully, if you want to have a conversation with me this week or next week, get with Paige. 630-492-1912, 630-492-1912. She'll set that time up and we can have that conversation. Have a great weekend. More next week.
Thank you for listening to Destination Retirement. Don't pay too much for taxes or retire without a sound retirement plan. For more information, please contact Robert Kuhn from Kuhn Capital Partners. Call 630-492-1912 or visit them online at kuhncp.com.
This recording is for informational purposes only and should not be considered investment advice. Kuhn Capital Partners does not provide legal, accounting, or tax advice. Any statement regarding such matters is explanatory and may not be relied upon as definitive advice. Opinions expressed are current as of the date of this recording, and such opinions are subject to change. The views and opinions of guests on this program are not necessarily those of Kuhn Capital Partners. Any reference to guarantees, principal or income, protection, buffers, or defined outcome investments are generally structured notes or fixed insurance products backed by the claims-paying ability of the offering company and are not insured by any government agency. Kuhn Capital Partners is not affiliated with any guests unless otherwise stated and does not guarantee the accuracy or the completeness of any data presented. Kuhn Capital Partners and its affiliates are not responsible for any trading decisions, damages, or other losses resulting from or related to the information, data analysis, or opinions in this recording. Past performance is not a guarantee of future results. All investments are subject to investment risk, including but not limited to the potential loss of principal. Advisory services are offered through Kuhn Capital Partners, LLC, a registered investment advisor.